This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
When we first saw the income tax computation back in Chapter 2, we saw that there were two main sources of earned income. They being income from self-employment, our trading income, which of course has just taken us some 5 chapters to work through there, and then employment income, obviously income from employment. You'll be relieved to hear that we've only got one chapter that deals with employment income here, as you can see on the screen, Chapter 9. It is, however, a long and most important chapter. Again, something will be tested on employment income in every examination you do. Again, whether it be in Section A or whether we find part of, or all indeed, of our Section C question on income tax concerned with employment income, I don't know. But it will be there in some way, shape or form. So what have we firstly got to look at here? Well, we just said there are two types of earned income. They being income from self-employment, your trading income, and income from employment here. In which case, what we may have is an issue about how to determine whether or not the income that you derive is from employment or self-employment. What constitutes employment compared to self-employment? And that's what we see here in terms of Section 2. Now, the basic rule of thumb is a simple one. Our main test, as we'll see here, of employment as compared to self-employment is whether we have a contract of service, which would constitute you being an employee, therefore what you get is employment income, to be assessed and treated under the rules we're about to see within this chapter, compared with a contract there for the services of the individual that would make you self-employed. So contract of service, you're an employee. Contract for services, you are self-employed. Now, it is true to say, though you will not have yet seen all the reasons for this, that an individual, if they could, would prefer to be treated as being self-employed. There will be an ease of getting deduction for expenses that attaches to self-employment, and it's rather more difficult to get expenses deducted in relation to employment there. Also, in terms of employment, the way in which the tax is collected through the so-called pay-as-you-earn system that you'll see and read about at the end of this chapter means that you will immediately be paying your tax as you receive your income. Whereas, of course, with trading income, that will come under self-assessment. You'll see the details of that again in a later chapter. Chapter 15, I think that one is coming up, where the rules of self-assessment will mean that there's a bigger gap between when you make your profits, you earn your income there, your trading income, and when actually you'll pay your tax there on. The issue, therefore, is it employment or self-employment? Now, the only thing that you can get tested on here, probably I would guess in a Section A objective testing question, would be a list of whether or not these particular issues would suggest employment. And we've got a list of them there in Section 2.2. What, in the absence of a very explicit contract of service, a contract of employment, what would suggest that the work that is being done by the individual is that of an employee rather than a self-employed unincorporated trader. Now again, you don't need to be reading through these now, but you will be needing to look at that closer to examination date. What we do need to focus on right at the beginning of our studies here is how are we going to establish, if we are an employee, what is the employment income assessment to include upon our income tax computation. Now, what we've got to know is that an individual will be assessed on, here's a lovely old word, the amount of emoluments there received. Now, that's important. Basis of assessment, actual amounts received within your tax year. Now, emoluments, as you will see here, include all the usual ways by which you'd expect an employee to be paid. Paid weekly, wages. Paid monthly, salary. Depending on the job that you do, you may receive a bonus. If, for example, you're in a sales team, you may well receive a commission based in relation to the levels of sales that you have achieved. And then what will occupy, in fact, probably most of our time here in this particular chapter, there's a whole series of potential benefits that could be provided by your employer. Now, most of these benefits, as we will discover, most of the ones that are going to be tested in your exam anyway, will be assessable benefits. And they will include probably the main example of an assessable benefit that you can probably think of now and that probably exists also in reality. And that would be the provision of a car, a company car provided there by the employer. Clearly, that's going to create an assessable benefit. Along with the car, as they're very expensive to run, running expenses, including fuel there, may also be paid for by the employer. And if fuel is paid for in any part, then as well as a car benefit, there will also be a fuel benefit. Now, various other assets could be made available for the private use of the individual if the employer was so minded. And where there are, then again, there has to be rules. Rules that say, this is how we will establish a quantifiable assessment figure. There's got to be a figure of income, a cost figure, a value figure to put into your income tax computation. It's got to be expressed in a monetary pound value there. So how we do that, again, is laid down for us. It's not up to us to decide what that benefit will be. They are prescribed by HMRC. What we'll also see at the beginning of that exercise is that, surprisingly, there are in fact some benefits that are exempt. And even more surprising, it's quite a big list. But there's not many of those that are hugely important. But again, we'll look at that very soon. So the individual, just like with the trader there, the unincorporated trader, we've got to work out what is their income. But of course, in deriving that income, there may also be expenses that are allowable deductions. And so it is for employment income, that what we'll be able to do is to deduct from these assessable emoluments any allowable expenses incurred. And that will be coming up in our next section. But what we've got here is, and we've already underlined that significantly, that the basis of assessing our emoluments, our wages, our salaries, our bonuses, our commissions, is on a received basis. Also then the assessable benefit that arose within the tax year. So a received basis. Now you'd think that received is very obvious. And indeed, when it comes to things like your wages and your salary, then of course it is. What did you actually receive between the 6th of April and the following 5th of April for your relevant tax year? But when it comes to tax, of course, we always have some strange rules. Usually, of course, to stop taxpayers sort of perverting that particular rule. The idea here, the date received is taken as the earlier of the date when the employee became entitled to the payment. Now, there we've got that new term, when you became entitled to the payment, or the date when it was actually received by the employee. Now, that's obvious. When did you actually receive it? When did the payment go into your bank account? When did you pick up that cash? But what may be earlier is the date when you became entitled to the payment. Now, you do not have to worry about how we may determine what that may be in various circumstances. You be told. So if you are told, therefore, that this is the date that you became entitled to the payment, here is the date that it was actually received, it is the earlier of those two dates that you will use. And where that normally picks up on is there in terms of bonuses. So you can't just delay the receipt of the bonus from one tax year to another to leave it therefore to a later point in time when that will be assessed. So what happens therefore, you may be told that a bonus was became entitled to, an employee became entitled to the bonus in, say, March of 2018, but did not actually receive that bonus until May 2018. Now, what that means, of course, is that March 2018 is in the 17-18 tax year, whereas the date of receipt, May 2018, is in the next tax year, 18-19. So what happens? We take the earlier of those two. Clearly, HMRC will be keen to assess you at the earliest possible point in time. So, date entitled March 18, it is before May 18, you would assess that bonus in the 17-18 tax year. Okay, that said, what about these expenses therefore? There may be expenditure that is incurred by the employee that is actually allowable. Now, it's not easy to get expenses allowed against employment income. What we have is, and we'll go to it to begin with, a general rule of allowability, which if you're uncertain about any particular item, you come back to this particular provision. And that is, to be an allowable deduction against your employment income, the expense must be incurred wholly, exclusively, and necessarily in the performance of the duties of employment. Now, back when we looked at trading income, when we got introduced to it in Chapter 4, what we saw there in the so-called adjustment of profit process for the unincorporated, the self-employed trader, was that expenses to be allowable simply needed to be incurred wholly and exclusively for the purpose of the trade. Now, it is more difficult, because now it's not just wholly and exclusively, it is also necessarily in the performance of the duties of employment. Again, as we suggested at the start, a reason why an individual may prefer, if they could, to be treated as being self-employed, but of course we may not be able to do that, and therefore this expense rule becomes more difficult to get an allowable deduction. There are some very specific examples that clearly are the ones that are most usually tested and we need to know about. Firstly, contributions to an approved occupational pension scheme within certain limits. And we've got a whole chapter, Chapter 10, not a huge chapter to be fair, but an own chapter dealing with pension contributions. Now, we have actually seen pension contributions already. I hope that you can remember back to Chapter 2. Now, back in Chapter 2, we saw that the taxpayer within the tax year may in fact have incurred personal pension contributions paid into their personal pension scheme. Now, if you recall those personal pension contribution payments there, they did not impact upon your calculation of taxable income, i.e. they were not allowable deductions to come away in deriving your taxable income. Instead, with a personal pension contribution, you were said to have gained basic rate tax relief at source. So, for example, if you paid £8,000 in the tax year into your personal pension scheme, your fund, your personal pension fund, would in fact be credited with £10,000. The fund would get your £8,000 directly from the employee and then be able to get back from HMRC the equivalent of the basic rate tax on what would have been £10,000 of your income. The gross figure, 8,000 times 100 over 80, grossing up for the basic rate of income tax, would give you a gross figure of £10,000. Obviously, a gross of 10 at 20%, there would be your £2,000 difference between the gross and the net figures. So you'd be told paid 8, you'd gross it up at 100 over 80 to get 10, and what did we then do with that figure, your gross personal pension contribution? Well, there were indeed a couple of areas where it was involved, but the one I would hope that you recall now immediately is that it would serve to extend your basic rate band if necessary, and further if necessary, your higher rate band limit. So if you had such a 10,000 gross contribution having been made in the tax year, instead of having a basic rate band limit of only £33,500, it would be extended by 10,000 to £43,500. What would that do? It would take £10,000 of your taxable income that would, without this, have been within the 40% rate band and push it back into the 20% rate band, therefore achieving an additional 20% saving. Hence, you got your higher rate saving. But those contributions did not get deducted from your income in relation to the computation of your taxable income there. They were personal pension contributions. What we now see is this approved occupational scheme here. This pension scheme is an occupational pension scheme, i.e. it is one run by the employer. Now what that will mean is that it isn't just the employee that may make contributions into the scheme on behalf of you, the employee. The whole point of an occupational pension scheme is with or without employee contributions, there will always be contributions made by the employer there. Now what we'll discover when we look at our list of exempt benefits is that when indeed the employer makes a contribution, it's something like a percentage of the salary of the individual, 5%, 7%, 8%, whatever, however generous the employer wants to be. But that amount paid in by the employer will be an exempt benefit. Then any amount paid in by the employee will be an allowable deduction against their employment income. So in deriving the employment income figure to include upon your income tax computation, you will deduct any occupational pension scheme contribution made by the employee. So for example, you might be told that the individual has an annual salary of £50,000 and that he or she has made an occupational pension scheme contribution here of, let's for example give a figure of 5% of your annual salary. 5% of your annual salary. So 5% of the salary of £50,000 would be £2,500. So that would be deducted in deriving the employment income. That would now be £47,500, and it is that figure that you would then include as employment income in your income tax computation and include it then, of course, within your non-savings income column. So there, the occupational pension scheme contribution paid by the employee, probably quoted as a percentage of salary. Get your calculator out and work it through and deduct it there in deriving the employment income figure to include on that computation. If we made a personal pension contribution of £2,500, that we would gross up times 100 over 80, and that would not show as a deduction against your employment or any other figure of taxable income on your income tax comp. What else might we see? Again, regulars, fees and subscriptions paid to relevant professional bodies. Yeah, well, one day you will be making your professional subscription there to the ACCA, and that, if incurred by you, will be an allowable deduction against the employment income, presuming that what you do is an accounting role of some description. So this contribution, this subscription that you make to the professional body is relevant to the job that you do, then that is an allowable deduction against that employment. Other ones, payments to charity made under a payroll deduction scheme. Now then, a moment ago, we differentiated what we see now as occupational pension scheme contributions from what we had seen in Chapter 2, personal pension contributions. You may recall, and if not, go back to Chapter 2 and check it out, please, before you take this any further, that back in Chapter 2, we saw that there was another payment made by the taxpayer during the tax year that would be treated just the same as the personal pension contribution, i.e. we would take the gross amount of that payment and use that to extend our basic rate band limit and, if necessary, our higher rate band limit. And those payments were again payments to charity, as we see here, but this time payments to charity under the what scheme? Now, where do we have payments made to charity in Chapter 2 under what scheme? That was the gift aid scheme. Now, with those gift aid payments, we do just like we did for personal pension contributions. We would multiply out the amount paid by 100 over 80, get the gross figure. That would not be a deduction against our income on the face of our income tax computation, but would instead, as we just said, serve to extend, where necessary, basic rate band and higher rate band limits. Well, we here in employment income see that rather than just having a personal pension contribution, we may have a contribution to an occupational pension scheme. That is a deduction, as we've seen there, from the employment income in going to your income tax computation. Well, now what we may also have is payments to a charity under this so-called payroll deduction scheme. They too would be allowable deductions here to go against your salary. What was ever paid to your favourite charities or charities of choice would be an allowable deduction from your employment income. Other possibilities, where again, I think pretty obviously there will be an allowable deduction if you incur travel expenses necessarily in the performance of the duties of employment. Now again, you'd expect probably, of course, that those expenses that you have incurred would be reimbursed by your employer. You wouldn't be expected to personally incur them. If you have, then they are an allowable deduction against your employment income. But more usually what we would see is that you have been reimbursed those travel expenses by your employer. Now, the reimbursement, the money that you got from your employer to compensate you for the costs that you incurred on the necessary travel expense going to business clients, for example, then that reimbursement to begin with would form a part of your employment income, a part indeed of those emoluments that have come from your employer. But that then will be matched by an equivalent deduction in relation to the travel expense that you incurred. So you would see it as an allowable deduction, but you'd have as income the amount reimbursed. If it wasn't reimbursed, there is no income, and you simply allow the deduction for that travel expense against your other employment income. Something similar to what you saw in trading income, that in relation to expenditure by the trader, rather more likely indeed on the trader, on plant machinery, you collected capital allowances. Well, it is possible here that we now get capital allowances available for plant and machinery provided by an employee for use in his duties. Now, you'd expect, wouldn't you, that if an employee needs certain plant, certain machinery to do their job, to again fulfill their employment, that would probably be provided by the employer. But if the employee had to provide their own tools, their own plant and machinery for this, then on that basis, capital allowances would be available, which inevitably, of course, given the small amounts that would be involved here, would be an AIA and 100% deduction available when it was incurred. But again, probably a less likely one. We mentioned when we first discussed emoluments how benefits would play a large part in this particular chapter, and probably the most tested benefit of all, car benefit, and potentially as well as the car benefit, a fuel benefit. But of course, it is not all employees that are provided with the luxury of a company car. And what happens is, if you've got to go out to a client, when you, for example, are, dare I say it, an auditor, and you go out visiting clients there, then you don't have a company car, you use your own car. In which case, what can we do in terms of claiming a deduction against our income for the use of our own car? And that's this bit. Section 5, approved mileage allowances here. Now, there are approved rates. These, though I don't think you'll have any trouble remembering them by the time you walk in the exam room, they're actually provided on your rates and allowances page. But they are. Now, this, remember, is where you do business mileage on behalf of your employer in your own car. Approved mileage allowance is 45 pence per mile for the first 10,000 business miles, and then 25p a mile thereafter. Employees who use their own motor car for business mileage must use the approved mileage allowances in order to calculate any any taxable amount arising from any mileage allowance received from their employer. Employees who use their cars for business mileage without being reimbursed by their employer, or more likely, as we'll see in a moment, or where the reimbursement is less than the approved mileage allowance, can use the approved mileage allowance as a basis for an allowable deduction. So what you're going to have is this, that although in real life most employers would use the approved mileage rates in reimbursing their employees, so there would be no assessable benefit on the employee, there would be no allowable deduction for the employee. In an exam question, that's not going to happen. In an exam question, that what is being reimbursed by the employer will be at a different rate to that of the approved mileage allowances. So you've got to do two calculations. For the amount of business mileage that has been incurred, we will apply the approved mileage allowance rates, up to 10,000 at 45p, above that at 25p. And we will compare that with the actual reimbursement that has occurred, whether we use a 30 pence, a 40 pence, a 50 pence rate, whatever it may be. And on that basis, if the amount reimbursed is greater than the approved rates, that difference is an assessment to include within the employment income assessment. If the amount reimbursed is less than the approved mileage rates, then on that basis there's a shortfall, and that difference will be an allowable deduction that the employee can then put against their employment income in deriving their final employment income assessment to include upon their income tax computation. Now, as an example here, I'll leave you to do that one for yourself, but if I just give you a quick example just to illustrate what we would be doing, then you can practice using example one for yourself. We're told that an employee during the year does 14,000 business miles. He or she is a very busy person. 14,000 business miles, and those are reimbursed at a standard rate of 35 pence per mile. And what we've got to work out is whether or not here there is an assessable benefit to be levied upon the employee, or whether there's an allowable deduction to be allowed to the employee and a reduction then against their employment income. So what do? We compare the amount reimbursed with the approved mileage rates. So what's the reimbursement? 14,000 times 35 pence per mile. So 14,000 at 35p. Ooh, should have put a calculator with me. 30 pence would be what, 42, half that is 7. I think, do check that out, £4,900. So that is how much has been reimbursed there. But again, check that figure, please. We then compare that with the approved rates. So what are they? 10,000 times 45p. Well, that, of course, would equal £4,500. Plus 4,000 more miles at 25p. That's easy enough as well. That is 1,000. Total, therefore, of the approved mileage rates would be 5,500. So that's what we could have been reimbursed. That is what we've actually been reimbursed. So in fact, we have been reimbursed less than the approved mileage allowance rates. So that difference, therefore, of £600 would be an allowable deduction that she could then claim against her employment income. If this figure here, instead of 35 pence, had been, say, 50 pence per mile, then 14,000 at 50p, that, of course, now would be £7,000. And 7,000 compared to 5.5 is a £1,500 difference. This time, had it been 50p a mile, clearly that is bigger than the approved rates, so that 1,500 would then be an assessable benefit and would be added into your employment income assessment. So, cars, therefore, in real life and in the exams loom large in terms of an employment income assessment. If the employee is using his or her own car, then in relation to the business mileage that they do, we do this comparison. The approved amounts against the actual reimbursements from the employer. If, of course, the company provides an employee with a company car, then, of course, we will see how we get the employment income assessment in relation to the car, and, as would be relevant here, in relation to the fuel benefit. Okay, moving on, therefore. Now, in relation to benefits, we said they're going to loom large here in terms of your examination, and that surprisingly, there's quite a big list of exempt benefits here. And again, something that you'll become familiar with over time. The more objective testing questions you do, and there'll be a lot of them again in the approved kits, that one of which at least you should have there, well, one of which you should have, and you'll be able to get practice on this in terms of what is assessable and what is exempt. But ones to look out for and others where I need a bit of explanation. Canteen available to all staff. Yeah, if the employer is providing canteen facilities, a cafe, restaurant, call it what you will there, but canteen facilities for lunch for their employees, breakfast, whatever it might be, then as long as there is provision that is made to all staff, that is an exempt benefit. Now then, a point here that sometimes gets picked up in questions. There may be, as it were, a workers' canteen and a management restaurant. But so long as the provision that is made in relation to those is the same, it is available to all staff, then that will be exempt. But it doesn't have to be exactly the same provision. We've got the works canteen and we've got the management restaurant there. As long, again, as the provision is available to all staff, then it will be exempt. You might have to move with the job. You've done such a good job where you are, they want you to go somewhere else and move locations there. Well, qualifying removal expenses up to £8,000 can be reimbursed by the employer, and that would be an exempt benefit. If therefore, as you'd think, if they are asking you to move, then they cover all of your removal expenses, and let's say the amount that you have incurred is £10,000. And they reimburse £10,000. They pay the £10,000. What will happen here is that if you've received £10,000 in relation to the expenses incurred, you get to deduct £8,000 against that. That would still leave you with a £2,000 assessment. Car parking at or near the place of work. Yeah, many of the larger organisations have a company car park, and you'd be allowed to park in there for free. That is not an assessable benefit, and quite right too, of course. What might be more surprising is if the company in question doesn't have their own car park, but they provide and pay for a car parking space within a paid car park, something like a national car park or something, NCP as we know them in the UK. If you've got a national car park where you have to pay, the employee has to pay, but that payment is either reimbursed or paid for by the employer directly, then that is still an exempt benefit. So whether it's the company's own car park or a paid-for car park by the employer, it's still exempt. Workplace nursery. So or creche as we might know it, if the employer operates such a scheme there, they pay for all of the resources. That is an exempt benefit. Now, of course, it's possible the employer hasn't got their own creche. They don't want that responsibility. Therefore, childcare vouchers may be provided to the employees. Now, depending on the level of taxpayer that the employee is, different amounts will be allowed as an exempt benefit. So if you're a basic rate taxpayer, you're allowed childcare vouchers up to £55 per week. Because if you've got an exemption as a basic rate taxpayer on £55 a week, at basic rate 20%, that means you'd be saving £11 in relation to that childcare voucher. You've saved If you'd been receiving £55 a week as a basic rate taxpayer, you'd be paying £11 basic rate income tax on that. But of course, if you're a higher rate taxpayer, they're not going to give you £55 and allow that to be exempt, because you would be saving twice what the basic rate taxpayer would be saving. £55 at 40% would be a £22 saving. That wouldn't be right. That provision saves one taxpayer 11 and another taxpayer £22. So what we've got is, if you go into higher rate, or if you go up to additional rate, indeed, levels of taxpayer, then the amounts that you're allowed exempt tax-free for: £28 a week if you're a higher rate taxpayer, £25 a week if you are an additional rate taxpayer. And again, if you multiply those out, for example, times 40%, 40% times 28, 4 times 8 is about, check it out for yourself, but about £11.20. And if it's £25 a week at 45%, then again, that's about 10, about £11.25. So it's near enough £11 a week. So it's giving you, therefore, the same effective tax saving. So you'd be told in the exam question whether or not the taxpayer is basic rate, higher rate, or additional rate. Again, you pick up those figures and you use them in terms of working out what the exemption would be. So if, for example, a basic rate taxpayer were to be provided there with childcare vouchers of £70 per week, then 70 less 55 will be £15 per week as the assessable benefit. If we've got £70 a week for the higher rate taxpayer, 70 minus 28 would be a £42 per week assessment. Again, for the weeks provided, if it was all 52 weeks, you can multiply it out and you'd have the assessable benefit there of the employee. Go above those levels of exemption, it is then assessable. Contributions by an employer to an approved pension scheme. Now, we started our discussion of that earlier in this chapter. Yeah, if we've got contributions into an approved pension scheme, in fact, whether that is to occupational or the personal pension scheme, that is going to be, again, an exempt benefit when paid for by the employer. Other ones to watch for: provision of a mobile phone. Again, one per employee. Not that you'd think an employee needs more than one. Mind you, you've got two hands, I suppose. If there was a second one, that would be an assessable benefit. Christmas parties for staff, up to £155 per person per year would be an exempt benefit there. That would be an exempt benefit. Sport and recreational facilities, yeah, again, encouraging us, of course, there to look after our health. Annual exemption of £500 per employee for employer pays for medical treatment to get you back to work there. That would be fine. Outplacement counselling, if you've been made redundant, again, to soften that blow, the employer, or about to be ex-employer, pays for that counselling for you. That would be an exempt benefit. A lot of people these days work at home some of the week there rather than going into and commuting in and out of work every day. So contributions towards additional household costs, such as light and heat, especially with the winter we've had, heat I'd say there, incurred by an employee who works at home, up to £4 a week, or if higher, evidence must be provided by the employee to justify the expense. But certainly, without question, £4 a week. Not that that's going to make a huge difference, of course, there. Long service awards, up to £50 per each year of service. What do we mean by long service? Got to be a minimum there of 20 years service. Trivial benefits, there's a lovely expression, more than, which do not cost rather more than £50 an employee, again, and are not cash or cash vouchers. That again would be fine. So it means we're not going to bother on such benefits that have basically cost the employer less than £50, obviously, for the year there. Other one to watch, this last one here, incidental overnight expenses provided by the employer for overnight stays. Up to £5 a night in the UK, £10 per night overseas. You'd be told how many nights, what has been paid there. The thing about this one is that if the amounts paid to the employee as this incidental overnight expense cover things like, telephoning home or whatever it might be there, if you go over those figures, the full amount is assessable. So if you were told it was £8 per night for the UK, the whole £8 is assessable. It's not 8 minus 5. If you were told it was £15 a night for overseas, the whole £15 is taxable there. It's not 15 minus 10. So again, little things to watch out for. Clearly, in reality, the employer and the employee are not going to have that. It will be £5 a night. It will be £10 per night as a maximum there, so there'll be no danger of any assessment. But an exam question, they could indeed have that. Now then, that's quite a list in terms of the number of different items there. There are far fewer in relation to what we have to study in the realm of taxable benefits, but those taxable benefits are guaranteed to be tested in some way, shape or form in your exam. But how we deal with those taxable benefits, that awaits us, of course, in our next session together.